Up tomorrow morning, you check your iPhone, Apple. You glance at your email, Microsoft. You grab a coffee from Starbucks, hop into your Ford, and drive to the bank to deposit a check at J.P. Morgan Chase. You probably think these are all different companies battling it out in the gladiator pit of the free market, right? Competition, capitalism, the American dream. Wrong. You've just spent your entire morning interacting with a single entity. Here's a number for you: $10 trillion. That's approximately the assets under management, AUM, of BlackRock. To put that into perspective, if BlackRock were a country, it would be the third largest economy on Earth, trailing only the United States and China. They have more money than the combined GDP of Germany and Japan. But the money isn't the scary part. How they use it is. BlackRock isn't just a bank. It's like a fourth branch of government. They own the house you rent. They influence which companies survive recessions and which ones fail. And they control a piece of technology, a literal supercomputer called Aladdin, that monitors the risk of nearly every single investment on the planet. Today, we're going down the rabbit hole. We're exploring the shadow government of finance, the deals, conflicts of interest, and the eerie silence surrounding the most powerful company in human history. Buckle up, because nothing, and I mean nothing, about BlackRock is normal. The $100 million failure, how it all began. To understand this financial monster, you need to understand the man who built it. And the ironic truth, BlackRock exists because a young, arrogant man made a massive mistake. The year is 1986. You are Larry Fink in your early 30s. You've got the 80s power suit. The hair is, well, it's there. You're a master of the universe working at an investment bank called First Boston. You're not just an employee, you're a legend. Your team practically invented the mortgage-backed security market, the very instrument that would later wreak havoc in 2008. You're making the bank millions and on track to become CEO. You feel untouchable. Then disaster strikes. You make a massive bet that interest rates will stay low. They don't. In just a few weeks, your department loses $100 million. In 1986, that's like losing $1 billion today. It's career-ending, soul-crushing humiliation. Larry Fink goes from golden boy to office pariah. People avoid eye contact. He's forced out. But here's where the villain origin story gets interesting. Most people would take their golden parachute and play golf. Larry gets obsessed. He realizes First Boston failed because they didn't understand risk. They were gambling, not investing. So Larry approaches another Wall Street titan, Stephen Schwarzman of Blackstone, with a bold idea. A new investment firm that doesn't rely on gut feelings or cocaine-fueled trading frenzies. A firm built on mathematical risk management. One that trusts computers more than humans. Schwarzman gives him a $5 million line of credit. They call it Blackstone Financial Management. Eventually, Larry's team performs so well they want more equity. Schwarzman says no. Larry responds, "Fine, I'm taking my ball and going home." They part ways. They rebrand. He wants a name that sounds strong, geological, and vaguely villainous, like something out of a Bond movie. He chooses BlackRock. That $100 million loss haunted Larry Fink. It left him paranoid about volatility. And that paranoia explains why, 30 years later, he doesn't just manage the market, he is the market. Larry realized something crucial. If you own a little bit of everything, you don't have to worry about one company failing. You simply own the whole index. You become the house. And, as we all know, the house always wins. The fourth branch of government, the bailout king. Fast forward to 2008, the global financial crisis. The world is burning. Banks are collapsing like dominoes. Wall Street is in full-blown panic. But inside the U.S. government, particularly the Treasury and the Federal Reserve, there's a different kind of panic. They're sitting on billions in toxic assets, garbage loans from Bear Stearns and AIG that must be absorbed to save the economy. Here's the problem. Bureaucrats don't know bond trading. They had no idea how to value this junk, let alone manage it. So, who do you call when the financial world collapses? You call Larry. The Federal Reserve, specifically Timothy Gaither, hired BlackRock to manage the bailout vehicles, famously known as Maiden Lane. Let that sink in. The U.S. government hired a private company to manage the government's intervention in the private market. BlackRock was given no-bid contracts to clean up the mess Wall Street created. They were the only ones with the data and technology, thanks to Aladdin, which we'll get to, that monitors the risk of nearly every single investment on the planet. This was the moment BlackRock stopped being just an asset manager and became a fourth branch of government. But it gets darker. Imagine you're a doctor treating a patient for a disease, but you also own the life insurance on the patient and the pharmacy selling the drugs. That's BlackRock in 2008. They were managing the bailout of banks in which they were shareholders. Did they have a conflict of interest? They said no. They built a Chinese wall between their advisory and investment arms, but realistically, it's all the same pockets.
If 2008 was the pilot episode, 2020 was the blockbuster sequel. When the pandemic hit, markets crashed again. Once more, the Federal Reserve needed help. They decided to start buying corporate bonds, debt from companies, to keep businesses afloat. And who did the Fed hire to execute this unprecedented program? BlackRock. Here's the kicker. The Fed authorized BlackRock to buy corporate ETFs, exchange-traded funds. And whose ETFs did BlackRock buy with American taxpayer money? Their own. BlackRock purchased billions of dollars of BlackRock's own iShares funds on behalf of the Fed. They collected fees for managing the bailout program and then collected fees again on the funds the program bought. It's the ultimate infinite money loop. This solidified their status. BlackRock is too big to fail. No, too big to jail. They are a structural support beam of global capitalism. If BlackRock goes down, your 401k, your insurance payouts, and even government solvency could collapse with it. If you're enjoying this deep dive into financial madness, hit that subscribe button. We're going to cover the companies that actually run the world. You won't want to miss the next one. And leave a comment. Do you think a private company should manage the Federal Reserve's money? Now, how does BlackRock actually manage $10 trillion without losing their minds? They don't rely on humans. If I told you there was a single supercomputer that effectively controls the global economy, you'd probably tell me to put down the sci-fi novels or take off the tinfoil hat. You'd think it sounds like Skynet from Terminator or Rehoboam from Westworld. But it's real. Right now, it's sitting in a data center in Wenatchee, Washington. It's called Aladdin. And the scariest part? We don't actually know how it works. It's a black box. The algorithms are proprietary. We just have to trust that Larry Fink and his team of engineers got the math right. And considering Larry started his career by losing $100 million because he got the math wrong, that's a lot of trust. 4. The illusion of choice. They have the money, they have the supercomputer, but how does this affect you personally? You might be thinking, I don't own stocks, I don't care about Wall Street. But do you eat? Do you travel? Do you watch the news? Because BlackRock is sitting at your dinner table right now. There's a concept in economics called horizontal shareholding or common ownership. It sounds boring, but it's the reason everything you buy is getting more expensive and often worse in quality. Let's play a game. Imagine you're at the grocery store. You walk down the soda aisle. Coca-Cola, Pepsi, fierce rivals, right? They've been battling for decades in the cola wars, theoretically driving prices down and quality up. But check the shareholders. Top shareholder of Coca-Cola? BlackRock. Top shareholder of PepsiCo? BlackRock. Now let's fly somewhere. Tickets for Delta, United, and American Airlines, competing for your business, right? Top shareholders of all three? BlackRock, usually alongside Vanguard and State Street, the so-called Big Three. Turn on the news. Fox News versus CNN, the ideological battlefield of America. Different masters? Parent company of CNN, Warner Brothers Discovery, top shareholders, BlackRock and Vanguard. Parent company of Fox News, Fox Corp, top shareholders, BlackRock and Vanguard. This is the illusion of choice. When the same institutional investor holds controlling stakes across an industry, the incentive to compete disappears. Why would Coke lower prices to steal customers from Pepsi if the owner of Coke also owns Pepsi? If Coke wins, BlackRock wins. If Pepsi wins, BlackRock wins. And if they both raise prices and squeeze the consumer, BlackRock wins double. Economists have studied this. There are papers suggesting airline ticket prices are significantly higher than they would be because of common ownership. Why offer a cheaper flight when your competitor is actually your portfolio sibling? And it's not just consumer goods, it's housing. Headlines show Wall Street buying up single-family homes, while BlackRock often points out that it doesn't buy as many individual houses as private equity firms like Blackstone. Remember, they're heavily invested in the companies that build and rent homes. They're invested in REITs, real estate investment trusts, that are turning America into a renter's society. When you hear the phrase, "you will own nothing and be happy," people often attribute it to the World Economic Forum. But look at the flow of capital. The engine driving the shift from ownership to subscription is largely powered by passive investment giants like BlackRock. They profit from the reliable cash flow of you paying rent, paying subscriptions, paying fees. They don't want you to own a house. Dead capital doesn't generate yield. They want that house to keep producing income month after month, year after year. That's the genius of their model. The name sounds almost cute: asset, liability, debt, and derivative investment network. But there is nothing cute about what it does. Aladdin is the operating system of capitalism. Remember how I said Larry Fink was obsessed with risk? He built Aladdin to be the ultimate risk radar. In the early days, it was just a tool to help BlackRock calculate bond market risk. But over time, it grew. It got hungrier. It needed more data. Today, Aladdin doesn't just manage BlackRock's $10 trillion. That would be too small. It's leased out to other massive institutions. Vanguard uses it. State Street uses it. The largest pension funds in Japan use it. Apple, Microsoft, and Google use it to manage their corporate treasuries. Even BlackRock's competitors pay BlackRock to use BlackRock's brain.
Because BlackRock is notoriously secretive, but analysts believe Aladdin monitors at least $21 trillion in assets. That's roughly equal to the GDP of the United States. Think about that. One software platform, created by one company, effectively tells the majority of the world's biggest investors what to buy, what to sell, and when to panic. This creates a terrifying phenomenon called herding. In the old days, if a crisis hit, different banks reacted differently. Some sold, some bought, some held. That diversity of thought helped stabilize the market. But what happens when everyone is looking at the same dashboard? What happens when half the global economy relies on the same algorithm? If Aladdin wakes up one morning and decides, say, that the pharmaceutical industry is too risky, it flashes a red light. Pension funds in Tokyo, hedge funds in London, and corporate treasurers in New York all see that same red light. They all sell at the exact same time. The market crashes, not because of fundamentals, but because the computer said so. It gets even more unsettling. BlackRock manages the Federal Reserve's bailouts, and the Fed uses Aladdin too. Let's map this out. The government uses Aladdin to regulate the market.
Banks use Aladdin to play the market, and BlackRock owns Aladdin. They are the referee, the player, and the person who built the stadium. This isn't just a monopoly on money, it's a monopoly on risk itself. If Aladdin were hacked or a rogue line of code introduced, we're not talking about a small stock dip. We're talking about freezing the global financial circulatory system. ATMs stop working, payrolls stop clearing, the world goes dark. Larry Fink insists that Aladdin is just a tool, a sophisticated calculator. But critics warn it's a central point of failure for the entire human race. It is the single greatest concentration of financial power ever created, and no one elected it. They aren't an evil monopoly in the traditional sense, like Standard Oil. They don't own 100% of one thing. They own 5 to 10% of everything. And that 5% is the magic number. It's usually enough to be the largest single shareholder, which means they control the board of directors. They influence CEO compensation, corporate strategy, and long-term direction. BlackRock didn't just beat competition, they solved it. They killed it and replaced it with a managed, predictable extraction of wealth from the bottom to the top. So the next time you're arguing with a friend about whether Ford is better than GM, or whether you should switch from Verizon to AT&T, remember this: you're watching two puppets fight. You're arguing about the puppets. You should be looking at the puppeteer. 5. ESG, the weaponization of morality. As if owning everything weren't enough, BlackRock has decided to tell those companies how to behave. This is where things get truly controversial, and where Larry Fink manages to receive hate mail from the far left and the far right. Enter the acronym that has set the business world on fire: ESG, environmental, social, and governance. On paper, ESG sounds great. Who doesn't want companies to be environmentally friendly, socially responsible, and well-governed? It sounds like corporate citizenship. But in practice, critics argue ESG is a Trojan horse, a way for BlackRock to bypass democracy and impose its own ideology on the world, using your retirement money to do it. Here's how it works. Every year, Larry Fink writes an annual letter to CEOs. It's widely considered the most important document in the business world. In those letters, he makes one thing very clear: BlackRock will use its voting power. And remember, owning the shares means owning the votes. If a company doesn't align with BlackRock's climate goals or diversity targets, BlackRock can punish it. If you're the CEO of an oil company and you don't transition to green energy fast enough, BlackRock can vote to remove you. If you're the CEO of a tech company and your board isn't diverse enough, BlackRock can vote against your re-election. This forces nearly every major CEO in America to cater to Larry Fink's worldview. He doesn't need to pass a law through Congress. He doesn't need to win an election. He just needs to threaten to dump the stock or fire the board. Take the case of Engine Number One, a tiny activist hedge fund. A few years ago, it wanted to force ExxonMobil, one of the largest energy companies on Earth, to change its climate strategy. Engine Number One owned barely any shares. On its own, it had no real power. But it had BlackRock. BlackRock threw its enormous voting power behind the tiny hedge fund, and together they successfully ousted 3 ExxonMobil board members against the company's wishes. It was a coup. A private asset manager effectively hijacked the board of a global energy giant to enforce a political agenda. BlackRock's defense is simple: climate risk is investment risk. Larry Fink insists he isn't being woke, he's just being a capitalist. If companies ignore climate change, he argues they'll lose money in the long run. He's just protecting your investment. But the counterargument is chilling. If BlackRock decides that manufacturing firearms is bad for society, it can effectively starve the entire gun industry of capital. If it decides certain media constitutes misinformation, it can financially suffocate those companies. What emerges is a system of corporate social credit, one enforced not by voters, but by algorithms, asset managers, and unelected financial power. And because BlackRock manages money for everyone, including conservative states and liberal unions, they are using everyone's money to push a single agenda. This has triggered a massive backlash. States like Florida and Texas are now pulling billions of dollars out of BlackRock, accusing the firm of boycotting the oil and gas industries that power their economies. It's the first time the giant has actually shown a vulnerability.
Little too late. When you control $10 trillion, does losing a few billion from Florida even matter? ESG proves one thing. BlackRock isn't just observing the market. They are actively shaping culture, influencing policy, and directing the future of energy, all without a single vote cast by the American people. 6. The revolving door, the shadow cabinet. You might be asking, if BlackRock is this powerful, why isn't the government regulating them? Why isn't the SEC breaking down their door? The answer is simple. The people supposed to regulate BlackRock are often waiting for a job at BlackRock, or they just came from BlackRock. In Washington, D.C., there's a phenomenon known as the revolving door. Government officials leave public service for high-paying private sector jobs and vice versa. With BlackRock, it's practically a hallway. Take the Biden administration. Media outlets quickly started calling his team BlackRock's cabinet. Brian Deese, director of the National Economic Council, Biden's top economic advisor, was previously global head of sustainable investing at BlackRock. Wally Adeyemo, deputy secretary of the Treasury, the number 2 spot at Treasury, was Larry Fink's chief of staff at BlackRock. Mike Pyle, chief economic advisor to Vice President Kamala Harris, was previously global chief investment strategist at BlackRock. And it goes the other way, too. Thomas Donnellan, President Obama's national security advisor, is now chairman of the BlackRock Investment Institute. Cheryl Mills, Hillary Clinton's top aide, has family connections in BlackRock. The list of connections is exhaustive. This level of integration is unprecedented. When BlackRock executives are literally shaping U.S. economic policy and U.S. policymakers retire to multi-million-dollar jobs at BlackRock, the line between public and private sectors dissolves. It creates a feedback loop. If you're a regulator, are you going to crack down on BlackRock knowing that Larry Fink might be your future boss? Probably not. This explains why BlackRock consistently gets no-bid contracts and is the go-to in every financial crisis. They aren't outsiders applying for a job, they're colleagues just switching desks. When people talk about the deep state, they usually mean spies and generals, but the real deep state wears Patagonia vests and stares at Bloomberg terminals. They don't control nuclear codes, they control interest rates, and arguably, that's more powerful. 7. The China paradox, funding the rival. Now things get geopolitically awkward. We've talked about how BlackRock pushes ESG in America, lecturing U.S. CEOs about being greener, more diverse, and socially conscious. Larry Fink insists American companies maintain a social license to operate. But at the same time, BlackRock is one of the most aggressive investors in China. In 2021, BlackRock became the first foreign-owned firm allowed to operate a wholly owned mutual fund business in China. This was a massive win for Larry Fink, who had been courting the Chinese Communist Party for years, arguing that integrating China into global markets benefits everyone. But here's where the hypocrisy alarms start ringing. China is not exactly known for its ESG credentials. We're talking about a country with documented human rights abuses, massive pollution output, the world's largest coal consumption, and a government that can make billionaires disappear overnight. Yet BlackRock is pouring billions of dollars of American investor money into Chinese companies. This means that your retirement money, your 401k, might be funding companies building Chinese military equipment or surveillance technology used against Chinese citizens. It got so bad that George Soros, the same Soros usually aligned with global elites, wrote a scathing op-ed in the Wall Street Journal. He called BlackRock's investment in China a tragic mistake and warned that funneling money into China jeopardizes U.S. national security and the interests of other democracies. When Soros is telling you you're too globalist and dangerous, you know you've gone off the deep end. Consumers and politicians started asking, why is BlackRock forcing American energy companies to divest from oil to save the planet, while simultaneously investing in Chinese energy giants pumping carbon into the atmosphere? Why is social justice mandatory for a company in Ohio, but optional for a company in Shanghai? BlackRock's defense is simple. Engagement is better than isolation. Investing in China, they argue they can influence it towards better practices. Critics call it greed. BlackRock sees the massive savings of the Chinese middle class and wants to manage that money, regardless of moral or geopolitical cost. This highlights the ultimate truth about BlackRock. They have no flag. They have no loyalty to any nation. They are a stateless entity. If the U.S. dollar collapses and the Chinese yuan takes over, BlackRock plans to manage those assets too. They are hedging against the decline of the American empire. 8. The housing market, the new feudalism. Let's bring it back home, literally, to your house. If you're a millennial or Gen Z, you've probably felt the crushing reality that home ownership may never be attainable. Prices are skyrocketing, interest rates are rising, and inventory is low. BlackRock often tweets that it doesn't buy individual houses, but that's a masterful deflection. It's a technicality. Sure, BlackRock itself might not be bidding on a 3-bedroom ranch in the suburbs. That's mostly private equity firms like Blackstone, Invitation Homes, and American Homes for Rent. But BlackRock is the major shareholder in the companies that do. BlackRock creates the capital environment that treats housing as a stock market asset rather than a place to live. By pouring money into the build-to-rent sector, they are fueling a transition economists call neo-feudalism.
The lords owned the land. The serfs worked it and paid rent to the lords. You owned nothing. You just existed on someone else's property. In the 21st century, the lords are institutional investors, and the serfs are, well, us. If the world's biggest players are betting on a future where nobody owns homes, they have the influence and the incentive to ensure that future happens. They profit from rising rents. They profit from housing scarcity. Every time you pay rent to a corporate landlord, a fraction of that money trickles up through the financial plumbing and lands in a BlackRock fund. They have successfully financialized the basic human need for shelter. And unlike a local landlord who you can call if the pipe bursts, these corporate landlords are faceless algorithms. They raise rents based on market optimization software, often running on data similar to Aladdin's, and evict with machine-like efficiency. So, when Larry Fink writes letters about stakeholder capitalism and caring for the community, ask yourself, how does a generation of permanent renters build a community? 9. The crypto takeover, if you can't beat them. For years, the one supposed safe haven from the BlackRock machine was crypto. Bitcoin was invented in 2009, right after the financial crash, as a middle finger to the banks. It was decentralized, permissionless, and uncontrollable, the anti-establishment currency. For a long time, Larry Fink hated it. He called Bitcoin an index of money laundering, said it was for criminals, and dismissed it as a bubble. Then something shifted. The eye of Sauron turned toward the blockchain. In 2023 and 2024, BlackRock did a complete 180. Larry Fink appeared on CNBC calling Bitcoin digital gold and a flight of quality.
Why the sudden change of heart? Did Larry suddenly become a crypto bro? Did he start browsing Reddit forums? No, he smelled fees. BlackRock applied for a spot Bitcoin ETF. Thanks to their near-perfect track record with regulators, it was approved. The iShares Bitcoin Trust, IBIT, became the fastest-growing ETF in history. Within months, BlackRock became one of the largest holders of Bitcoin on the planet. This is the ultimate co-optation. They took the one asset class designed to disrupt them and turned it into another product in their portfolio. Hardcore crypto enthusiasts are horrified. If you are buying Bitcoin through a BlackRock ETF, you don't own the keys. You hold a receipt saying BlackRock owes you money. And remember Aladdin? Now it's monitoring the crypto markets too. BlackRock is bringing institutional control to the Wild West. Crypto is no longer a rebellion. It's part of the establishment. BlackRock didn't kill Bitcoin. They put a suit on it, dragged it into a boardroom, and told it to behave. They realize they don't need to control the currency if they control the on-ramps and off-ramps, and now they own the toll booth. 10. Final thoughts. The monster in the shadows. So where does this leave us? We've covered $10 trillion in assets. We've explored Aladdin, the supercomputer that controls the global economy. We've examined the revolving door into the White House, the hypocrisy of ESG in China, the housing market, and the crypto takeover. Zoom out, and the picture is terrifyingly clear. BlackRock is not just a company, it is a gravity well, a black hole that sucks in capital, political power, and data, compressing it into a singular point of control. Larry Fink is arguably the most powerful man in the world. Presidents come and go, prime ministers resign, but Larry remains. He manages the money for countries, pension funds, and billionaires. And the genius of it all? It's boring. BlackRock isn't a Bond villain with a laser on the moon. They're a boring asset manager with a boring logo and boring offices. They hide in plain sight. They hide behind the complexity of finance. They count on most of us tuning out when they start talking about ETFs, index weightings, and derivatives. They count on our apathy. They want you to think the economy is just the invisible hand of the market, but it's not invisible. It has a name, and it has a CEO. Is BlackRock evil? That's for you to decide. They would argue they are bringing stability to a chaotic world. They help grandmas retire and assist the Fed in stabilizing the economy. But the price of that stability is centralization. The price is freedom. We have concentrated the decision-making power of the entire human race into the hands of a few people in New York City and a computer in Washington State. History tells us centralization works great until it doesn't. If Aladdin ever gets it wrong, or if BlackRock ever fails, there is no one left to bail them out because they are the bailout. So, the next time you buy a Coke, book a flight, pay your rent, or check your 401k, remember, you aren't just participating in the economy, you're feeding the beast, and the beast is always hungry. If this video terrified you, or if you learned something new about the shadow rulers of the economy, smash that like button. It helps the algorithm, which, ironically, is the only algorithm we like around here. Comment below, do you think BlackRock should be broken up, or is this just the natural evolution of capitalism? I read every comment. And if you want to learn about the other giant company that controls the rest of the world, look out for our upcoming video on Vanguard. Think BlackRock is secretive? You haven't seen anything yet. Thanks for watching. Stay safe out there.